Hey guys, hope you all are doing good. This is Shaun bringing you guys another video, and in this video I wanted to talk to you guys about different types of brokers. Now oftentimes by my friends or family, or oftentimes when I'm meeting other people in the gym or wherever, and once they realize that okay, I'm a trader and I've been trading financial markets for a really long time, I've been doing pretty good at it. So the question would usually come up about who are you trading with, who's a good broker, and who can I get started trading with, and things of that nature. And so I thought of making this video about talking about what are the different types of brokers to even be looking for, depending on your trading, of course. And once you understand what different types of brokers are out there and what to actually look for, then you can start going on to broker's website and look at the reviews and ratings and things of that nature, and then make your own decision. But yeah, this video is mostly going to be about that. And if you stick around till the end, I also wanted to talk to you guys about crypto trading and why I have kept out of or stayed out of trading crypto as a market. Even though the moves are really, really tempting, the market offers some really, really clean patterns and clean moves, and it's arguably a lot more easier to trade compared to stocks or anything else, in my opinion at least. So, but yeah, we'll talk to you. I'll talk to you about that in just a bit. So starting off with the very first type of broker would be full service brokers. And I'm going to start off with the least recommended to the most recommended. So that's just going to be the flow of it. So full service brokers, as the name suggests, they offer you all sorts of services in terms of news, analysis, portfolio management, even your research, all types of support that you can expect. They do provide. The flip side of that is they're generally very expensive, and they have a lot higher commissions and fee structure, which could actually really add up to your P&L. Or they're mostly suited for really large investors who want to be very, very passive with the portfolio, and they're okay to rely upon somebody else doing all the work and they just executing the positions, or they might not even have to execute the positions, basically almost a portfolio management sort of service. But I'm personally a believer that you need to know at least the minimum of what's going on in the market and then make your own decisions. And it's okay to rely on somebody else's research and the legwork, but at least you need to be aware of what's really going on in the market and where do you want to execute the positions, or maybe you want to say no to the professional whoever is supporting you or helping you with that service, that okay, this is not something I want to put my money in. So at least that's the bracket sort of I fall into, having enough knowledge and understanding, and then choosing whether you want to give your time to it or not. The second type of brokers we'll talk about is CFD brokers. Now, these are the brokers who are cold calling you every 2 days, and you're seeing a lot of Google ads and Facebook ads of these guys, and they make it sound like you can get rich tomorrow, pretty much. And these are the brokers. They're good for some reason, and they do have their own place, and they're good for something, but personally, not my preferred choice for trading, and here's why. So CFD brokers, as in CFD really stands for contract for difference. The very first thing with contract for difference or CFD brokers is you are never owning the asset itself. You're simply trading the price fluctuations of the underlying asset. So an example would be, let's say Apple shares are trading at $100 a pop. So if Apple, you can still go and buy that same Apple share, and it's going to cost you again $100. If it does move by, let's say, 10 points, you're still going to be able to capitalize on that 10 points. But it gets a bit tricky where, or at least it gets less favorable when it comes to your trading, because with CFD brokers, your spreads are really, really wide. Oftentimes they would claim that you're not paying any commissions, but the spreads are just so wide that it ends up being a lot more expensive than actually paying the commissions itself. They're good for trading forex. It's easy to get forex and things of that nature, like those kind of assets. But when it comes to stocks, because you're not owning the asset, and the reason you're not owning the asset is because you're not connected directly to the exchanges where these assets are being traded. So a CFD broker is going to take your order, keep your order with you, and then execute that order in the real market with the real exchanges. So there is a middle person basically. And oftentimes that could lead to is a lag in price. So if Apple or any other stock moves by quick 1-2%, and when it comes to market open, these prices do fluctuate really, really quickly. So there can be a lag that can be experienced by the trader. And because you guys are not directly, or because a CFD trader is not directly connected to the exchanges, you don't have very important information such as what sort of execution, or in easier words, you don't have access to level 2 box and the tape. So what these two things do is they give you what orders are actually coming into the market and what orders are being executed. Now, this is pretty important for me as a trader, because when I'm looking to trade a stock, let's just take Apple again as an example. And if I want to buy support and I'm just waiting for the price to reach support, and then I can see if a lot of executions are happening on that particular support level that I was looking at, and a lot of buying orders are being executed over there, that can give me a lot more conviction and confidence in my personal trade. And then that's where I can decide to either execute the position, and if I don't see that buying coming in, I may be okay to just leave that trade alone or not execute at that very moment. Or a lot of good traders, including me at times, when I have a really high conviction behind a position, and when I see something like that on the tape, I might even go twice or thrice the size than what I'm normally risking. So it can be a huge edge when you're looking to trade. So these sort of things are not available with CFD brokers. And of course, lag is something I already mentioned. You also don't have access to pre-market and post-market data, since you're not connected to the exchanges. And mostly bigger one for me would also be that these brokers are not always very strictly regulated. Like CFD brokers are not always the kind of best, and there are some good ones out there, but there are also a lot of shady ones out there which could be a little bit difficult or tricky to actually find out and sort of avoid. And the next brokers I actually want to talk to you guys about, and these are the preferred brokers that I trade with, and I would highly recommend for anybody who's looking to trade stocks and options, is direct access brokers. And as the name suggests, right, you have direct access to the exchanges when you're making trades or when you're placing trades. You are also owning the asset when you're trading, and if you buy Apple shares, you actually become the owner of those Apple shares. And from a trading perspective, regardless of whether you're looking to day trade, swing trade, or even hold on to positions for a really long time, these stock brokers can be really advantageous because, first and foremost, I've already mentioned the level 2 box and the tape. That can give you a lot of transparency in terms of information, what's really happening, going on in the market. So you have a much broader perspective or picture what to execute on, if I can put it that way. Because you have a lot more information, you can have more clarity in terms of your executions. And the second one is these brokers also give you access of pre-market and post-market data. So pre-market and post-market is basically the market opens at 5:30 p.m. for me, Dubai time, but 9:30 a.m. Eastern, and it goes on about 4 p.m. Eastern again. So there are these 4 hours before the market opens and 4 hours after the market closes. You can still execute your positions and place your trades. So a lot of larger funds tend to gravitate towards executing the positions after the market closes and after all the action has been taking place. And a lot of day traders generally gravitate towards pre-market, because before the markets open, before the bigger players come and place their big and large orders, they already have a head start. So these are big advantages when it comes to trading or long-term investing sort of thing. But these are very good hours and can give you a huge advantage when it comes to trading. So these are the things that I'm missing. And lastly, with these brokers, they're very strictly regulated. Your funds are insured. Let's say if anything were to happen and that particular broker goes belly up, your funds are still insured, and there is a reasonable opportunity for you to get your funds back or money back. And I believe your funds are insured up to $500,000 or something, if I'm not mistaken. So those are some huge advantages when it comes to direct access brokers. Another advantage that I wanted to talk to you about going back to my previous CFD brokers is getting started with them is super easy, where you can just get started when you can just fund your account with $100 or $500 and get started, and at least see how charts move and price fluctuates and placing trades and get a feel for it. But when it comes to direct access brokers, generally the barrier to entry is slightly higher. I think a lot of brokers have a minimum of $10,000 just to get going, and I know some really good brokers have a minimum of $30,000 to get started with them, just to open an account with them. And because these brokers are also very strictly regulated, they have to follow all the rules and regulations of the US or SEC. So you also are hit by PDT rule. So PDT rule stands for pattern day trading rule, and what it stands for is any investor or trader having less than $25,000 in their trading account is not allowed to day trade or place entries and exit in the same day. So that is one more thing, but there are easier ways to get around it. But yeah, so I hope this video sort of did give you that clarity between the different types of brokers. And going on to the point I was making earlier about crypto trading and why I have kept away from crypto trading is because crypto brokers and crypto market is just not very strictly regulated enough. The recent example would be FTX, which was the second largest broker on the planet for crypto traders, and that just went belly up. And think about how many traders and investors would have funded their account with them, and since they just went bankrupt, a lot of those traders and market players are just not able to access their funds again. It's one thing to lose your money trading poorly and then losing that money all that way, but it's a whole another pain of losing money where you just broker goes bankrupt and you just can't access those funds. So that's one thing. But the bigger reason for me was first and foremost, trading is a skill, and this is something very important for anybody listening to this video should understand. Trading is a skill. It's simply a skill of finding good opportunities which have lesser risk compared to the reward, and just being able to execute those trades and manage those positions and manage your risk appropriately. So that's the first thing. So if you are a good trader, you're going to make money regardless of the market. And secondly, anything major that happens on the crypto market, there are related stocks, such as whenever something big would happen with Bitcoin, there would be related stocks such as Coin or Mara, or these stickers would just make those similar sort of moves or bigger moves. And if you don't want to risk your funds with crypto market, you can still take advantage of those same things that are happening in the market, but now you're just in a much more safer environment where with stocks and with regulated brokers and things of that nature. So first and foremost, trading is a skill. So it has nothing to do with what market is making big moves or what market is really good. Because I've seen good traders, when the market is moving just 2%, they're still really killing it when it comes to the year end. And there are other traders which are just getting started or maybe are not that developed in terms of their skill yet. They would trade, I can't remember of an altcoin name, but I believe there was a really famous one which pretty much everybody I knew was trading at that time. It went up by like 500 or 1000% or something, and everybody that I knew was bag holding it. They were losing money on it, whereas that particular coin just kept going up and up and up, and things of that nature just happen. So trading is a skill. So regardless of whatever moves are happening, wherever they are happening, you need to be able to find the opportunity and extract the money from the market. Going to do that. So that's one of the main reasons that I just kept away from crypto market, because I can still take advantage of similar moves with relevant stocks. So, but yeah, I hope this video helped you and gave you a bit more insights when it comes to choosing a broker or choosing a type of brokers when you're looking to trade in the market. And yeah, if you did, consider hitting the like button and subscribe to the channel to see more trading related videos. And I hope to see you in the next one. Take it easy. Cheers.